Hello everyone, welcome to INR Bond Search for Yields, issue number 76. I am Nikhil, and in today's topic, I'll be discussing about how the compounding inflation hurts the passive fixed income investors. So the investors in passive fixed income instruments like fixed deposits or short-term mutual funds, which are yielding much lower than the pre-tax levels itself are lower than the inflation levels. They're not even coming close to the break-even. The post-tax would be much worse. Here the catch is the difference between the inflation and this low-yielding assets is not the loss the investor will make. The compounding factor will come into the play, and the losses would look much larger than the normally what they're expecting it to be. The compounding is a wonderful tool for an investor if it's working in their way. Like if they're gaining if the money is growing, the compounding will make the money grow at much faster rate. And in the same way, if the things go south, the losses will pile up in a much larger way. Let me just take you through what are the key reasons why we are seeing such kind of higher inflation. So before pandemic hit the global economies, that's before 2020, the developed nations like US, Eurozone, Japan, they were witnessing the inflation under 2%, and most of them have set the inflation target of 2%. Japan itself have not seen inflation above 1% for for almost a decade or 2 decades. So right now, the US and the Eurozone are witnessing the record high inflations. When the pandemic hit the global economies, central banks across the globe have set the interest rates at the record lows, which caused the liquidity in the market to rise. And the cheaper money also pushed the purchasing power of the consumers, which in turn led to the higher demand for goods and services. The problem is not the higher demand, but the problem is with the lower supply. There is no the supply demand mismatch caused the prices to rise at much faster rate. The commodity prices, the metals, especially the iron ore or aluminum, have touched the levels of 2007. And also, we have seen the raw material prices for most of the finished goods also rising in the double digits. The uneven time frame of the pandemic lockdowns across the world caused the supply chain disruptions, which in turn rose the logistic and transportation costs for the goods and services. And all in all, these higher costs of raw materials or the logistic services resulted in the higher inflation. And the last but not the least, the Russia-Ukraine crisis, which is currently ongoing, has caused the oil prices to touch 2014 level highs of $130 per barrel, and also the food inflation rose because of the Russia-Ukraine export majority of the wheat to the world. And these factors push the inflation in US over and above 7%, and Eurozone also witnessed the record highs of inflation. So the central banks right now are bracing for higher inflation, and their inflation target for this year for US is set at 4.5%, which is much higher than 2% targeted range. So the Fed the rose interest rates by almost 25 basis points, and in the coming rest of the year, they're expecting 6 more rate hikes. So the inflation definitely played the spoil sport during the pandemic, and which also spooked the central bank investors. The fixed income investors are paying the cost for such higher inflation. The traditional fixed income investors who have been investing in passive instruments like fixed deposits and mutual funds, they are yielding on an average currently of 4% and 5%. And the latest reading in India, the inflation is at 6%. And if you see the gap between the inflation rate and the FD rate is just 2%. But as the every year passes by, the losses become higher because of the compounding. And here, if I can show you in the table, I've just taken the inflation at 6%, and on an average, the 1 year and 1.5 year FD rates are at 4%, and the mutual fund returns are at 5%. And if you have invested 100 rupees today, after the year one, these would be your payoffs. And clearly, if you see, there is these assets are yielding much lower than the inflation. And if you see the from year one and to year two, there is a significant difference between the differences between the passive assets and the inflation. And similarly, the year three, the difference become huge and huge. And if you take the compounding into the whole calculation of the returns, here the returns would look like. And the year one, the FD investors making a loss of close to 2%, and mutual fund investors are making a loss of close to 1%. However, this is not the case if the investor continue to invest in such assets. The year three payouts will be FD investor would be making a loss of 5.5%, and mutual fund investor would make a loss of 3%. And if you keep increasing the time frame, the losses will get increasing only. Because as the difference, if you take for this year, let's just say in the year two, the investor is making a 4% on a FD, and the inflation is at 6%. There is a 2% gap. So this 2% gap for this year and the year one of 2% gap which you already made, all this amount gets compounded, and the returns, the losses gets wider and wider. But what is the solution for them? What can help them to make the losses even they have come to close to the even if they come to close to the break even, or if they even beat the inflation? In the next slide, I'll just show what are the assets that the yield on the assets that required in order to beat the inflation. So if investor already started with fixed deposits or the mutual fund, and in the year two, if he understands that he is losing a lot of money and he has to invest in higher yielding assets in order to beat the inflation, the asset in which he has to invest is any asset which is giving him 8% or above, and that's for the FD investor. And for a mutual fund investor, the asset should yield 7% and above, because he has to beat the inflation in the year two, and as well as recover the money that he lost in the year one as well. If you see the number that increases from the 8% to 10% from year two to year three, and for the mutual fund investor, it increase from 7% to 8.3%. Because as many years you keep on losing money because of low yielding assets, the next year you have to invest in much higher yielding asset in order to recover the loss from the previous all years, and also the current year you have to beat the inflation. Here the good news for the Indian investors is that Indian corporate bonds do offer such kind of yields on such on few corporate bonds, or also they have many different options right now in fixed income space. You can come on and check out our QuickInvest app, where you can set your parameters of returns from 8% or 10%. Check out what all bonds are available with us, and you can invest with them. But however, if you see the US citizens or the Europeans, if they want to do the same, so slightly it's more of a impossible task, because the inflation is at 7% for US people, for US citizens, and the bonds which are offering them is at 2%. In order to beat 7% inflation, they can't even they don't even have assets, fixed income assets which are offering over and above 7%. So here, here in India, we have enough bonds or other structured fixed income products where we can invest and beat the inflation, also and make up to the losses in the previous years. And in order to check out all the bonds which we're offering, do sign up on our QuickInvest platform. Which is we have an app which is available in both the Play Store and App Store. You can also sign up for the app and check out the bonds. We're also hosting a masterclass event on how to generate an alpha. Alpha is an extra return over and above the inflation or your ultra short-term fixed income instruments. Mr. Arjun Parthsarthi will be speaking about it on this coming Saturday at 11 a.m. And we'll also talk about understanding the US Treasuries, which has inverted in the first week of April, and also these yield curves. and you'll get a chance to ask your queries if you have any. And the registration link is given in the description below. If you find our video useful, give us a like and subscribe to our YouTube channel. Thank you for listening.